Everyone researching whole life insurance eventually hits the same wall. Non-direct recognition is good. Direct recognition will punish you for borrowing. End of story. And the people saying that, they usually only sell one type of policy. So of course that's what they tell you. I've compared both across hundreds of policies and run the real numbers side by side. In this video, I'm going to walk you through exactly how both policies work and show you what actually drives your cash value, because it's not what agents are telling you. When you borrow against your whole life policy, the insurance company has one question to answer. Do they pretend the loan doesn't exist when they calculate your dividends, or do they acknowledge it? That's the entire difference between non-direct and direct recognition. Everything else flows from that one decision. With non-direct recognition, the company doesn't see the loan. They see you've got $100,000 in cash value and you borrow $50,000. The company pays a 6.6% dividend on the full $100,000. The $50,000 sitting there untouched and the $50,000 you borrowed. Same rate on everything, because as far as the general dividend calculation goes, the loan doesn't exist. The trade-off is a variable loan interest rate. Right now with Mass Mutual, it's sitting around 5.1%, but it moves with the economy. In 2022, it bottomed out at 3%. In a high rate environment like the 1980s, it climbed to 8 to 9%. You're getting the full dividend on your entire cash value, but you're also accepting that your loan cost can move. Direct recognition works the other way. The company sees the loan and applies a different dividend rate on the borrowed portion of your cash value. Not the same rate, a different one. Now here's where most people stop listening and assume different means less. That assumption is exactly where the myth starts, and I'm actually going to show you the actual numbers in a minute. The trade-off with direct recognition is the fixed loan interest rate. Mass Mutual locks it at 6% for the life of the policy. Guardian locks it in too, with a provision that drops the rate to somewhere between 3 to 3.5% once you hit the ladder of 20 years or age 65. That's a contractually guaranteed rate reduction built into the policy. So you've got two levers moving at once with direct recognition: a fixed loan rate and a modified dividend on borrowed cash. Most people hear the modified dividend part and tune out. But when you look at what Guardian has actually done with the dividend rate over the years, the story changes completely. And that's exactly where we're going next. Guardian is a direct recognition company, and their history is the clearest proof that the different dividend rate doesn't actually mean a worse deal. Before 2016, Guardian policies had a fixed loan rate of 8%. But Guardian also paid an 8% dividend rate on the borrowed portion of the cash value. You paid 8% in loan interest and you earned 8% in dividends on that same money. The net effect on the borrowed cash was zero. It was a complete wash. The loan cost you nothing in terms of dividend loss because the company offset it entirely. The loan cost you nothing in terms of dividend loss because the company offset it entirely. Then from 2016 through 2021, the fixed loan rate dropped to 6% and the dividend on borrowed cash value also 6%. Still matched, still a wash. The structure changed, but the outcome didn't. After 2021, the fixed interest rate sits at 5% and the dividend on borrowed cash value is 4.5%. So there's a small gap, a slight reduction, but Guardian's long-term provision matters here. At the ladder of 20 years in force or age 65, the fixed loan drops contractually between 3% and 3.5% depending on the product. That's locked into the contract, so the borrower holding the policy into their 60s, looking at a loan rate well below anything a variable rate would likely hit in the same environment. The short-term 0.5% gap looks a lot smaller when you zoom out. So let's get into the actual side-by-side numbers, because this is where the myth falls completely apart. Mass Mutual is the only major mutual company that offers both recognition types on the same product. The same company, same policy design, same premium. When you apply, you choose variable loan rate, which gives you a non-direct recognition, or fixed loan rate at 6%, which gives you direct recognition. That choice is permanent. It's locked in at issue because it's the same product with one variable change. It's the only true apples-to-apples comparison that exists on the market. So here's the setup: $100,000 a year in premium for the next 5 years, a $500,000 loan taken out year 6 and repaid at $100,000 per year. With non-direct recognition, the variable loan rate sits at 5.1% and the full 6.6 dividend applies to everything. Borrowed cash value and non-borrowed cash value. No distinction. The loan pays off by year 12. At payoff, the cash value is roughly $764,000 and the death benefit is around $1,025,000. With direct recognition, the fixed loan rate is 6%, higher than the 5.1 variable. The dividend on borrowed cash value is higher than what the non-direct pays on the same money. The loan takes slightly longer to repay because of the higher rate. Over the life of that loan, you pay about $20,000 more in loan compounded interest to the non-direct option, but you also receive about $13,000 more in dividends. The net out-of-pocket difference is roughly $6,700. On paper, direct recognition costs you more to borrow, and yet the cash value at payoff with direct recognition is approximately $822,000. That's $58,000 more than the non-direct option at the same point in time. That gap doesn't shrink, it grows because the direct recognition policy exits the loan with more cash value that larger base compounds forward. Every year after payoff, direct recognition pulls further ahead. So how does paying more in net loan cost produce more cash value? The higher dividends on borrowed cash during the loan period fed back into the policy. The net cost is slightly higher, but the policy itself is larger because of it. The loan interest cost and the cash value outcome are measuring two different things. Most people only look at one. The interest rate environment is actually what shifts the advantage. In 2022, Mass Mutual's variable rate had a floor of 3%, and the dividend rate was 6.6%. Non-direct was an obvious win. You borrowed at 3% and the full dividend applied to everything, and that spread was enormous. In the 1980s, the opposite was true. Variable rates climbed to 8 or 9%, and the fixed 6% on direct recognition looked like a gift. Right now, at 5.1% variable versus 6% fixed, it's close, and the case study shows direct recognition producing more cash value long-term despite the tighter spread. Actuaries built both options to land in roughly the same place over a full policy lifetime. If one consistently crushed the other, the losing option would disappear. They haven't. That tells you something. Most agents are contracted with one or two companies, and that's it. Not because the data says so, it's because that's what they sell. Non-direct is also just an easier story. Same dividend on everything, no nuance, no explaining how the dividend on borrowed cash value works. Agents who lead with non-direct often do it because it closes faster. Simple narrative wins in sales conversations, even when simple isn't accurate. Here's the tell. If an agent tells you non-direct is definitively better without ever mentioning the interest rate environment, without comparing dividend treatment by company, and without running an actual side-by-side, they haven't done the comparison. They've repeated what they've been trained to say. What matters more than recognition type is how the policy is designed. Minimum base premium, maximum paid up additions, and placing it with one of the major mutual companies. That's what determines how fast your cash value really grows. Recognition type affects the loan math at the margins. Policy design determines whether the whole thing works in the first place. When someone genuinely used both types and run real comparisons, they'll tell you it depends on the rate environment and specific company. That answer sounds less confident, but it's the only honest one. The recognition type debate is a distraction. Interest rates determine what looks better on paper at any given moment, and the net results land close enough that actuaries built both to stick around. Before your next conversation with an agent, ask them to show you a side-by-side comparison on the same product. If they can't pull that up, you know why. If you want to actually put any of this to work, the next step is understanding how to borrow against your policy in the first place. The mechanics, the process, and what to watch out for, I've already made that video and it's the natural next step from here. Go watch that one now.